rates. So we'll jump into rate the rates. Yeah. So where are we today? Today we are in a really interesting time because rates have gone up almost 2% since the beginning of the year.
It's so crazy.
Let that sit on you for a second. Almost 2% in 3 months.
Have they ever gone up that fast before?
Yes. One other time when we started quantitative easing and stopping that whole process coming out of the mortgage meltdown, rates jacked up like this. In my professional career, rates also jacked up like this at the beginning of the 80s when inflation was rampant, similar as of today. And at that time, the federal chair, Volcker, jacked up the short-term interest rates over 2% in 1 year.
Volcker?
Yes.
That's a great word.
Great word.
Learning all sorts of things here.
So I see similar situations going on right now in our economic situation going on. We have interest rates going up. We have inflation all over the place. We have a Federal Reserve Board that wants to kind of put the inflation situation in check. And the way that we do that, you guys, is by increasing interest rates, right? So they're doing that. They're increasing interest rates.
But let's define this a little bit because this is one I get asked on a lot, and I'm sure you do too.
Okay.
When we say increasing interest rates, we're not specifically talking about mortgage rates.
Correct. That is correct. We're talking about short-term interest rates for the banks and the short-term interest rate. You guys all know that's tied to your credit card, the prime rate. Right. So those two rates that they're offering are, in essence, going up. So how does that impact us? What they're trying to do is slow down the economy through this increase in interest rate. So number one, the prime rate that's going up is going to increase your credit cards.
Yep.
It's going to increase your home equity lines of credit. It's going to make things a little more painful in those departments. So those of you that have credit cards out there, even though with rates going up, it might be a really good time to look at a cash out refinance and consolidate all that debt. We can jump into that at a later time, but we're not going to go there today. It's still a great viable asset or option. And then basically with the increase in interest rates and the slowing of the economy is ultimately what they want to do, will, help that curb that inflation number going up and up and up and up, right? The other thing that we have some really unprecedented times. In the 80s, we didn't have COVID. We didn't have a skirmish in between the Ukraine and Russia right now. We didn't have the supply chain issues that we have. We didn't have semiconductor manufacturers going out of business or not in business right now to produce these manufacturing things that are in everything today. I don't think short a cup of coffee or your water that you can buy something that doesn't have a microchip in it today. But long story short, rates have gone up. So we wanted to share a quick example of where rates were at the beginning of the year and where rates are right now. So I put together a great tool that I use. It's called Mortgage Coach, and it's a mortgage illustration. So bringing that up on the screen here. Some of you on your phone, sorry about this. This is a little bit small, fine print, but you guys can click on the link. We'll drop the link in the chat here, and you guys can all take a look at it at your leisure. But what I wanted to show you guys is what I think is starting to manifest itself, and we're going to talk about this in 1 second with Darcy, what's starting to manifest itself in the inventory situation that we find ourselves in, that listings are coming on the market and maybe not having as much pomp and circumstance. But if we look at where we were at the beginning of the year in the first column, when we ended 2021, the 30-year interest rate per the Freddie Mac rate survey was 3.11%, right? So that's in column one. Column two is last week's mortgage survey for Freddie Mac rates. We're showing a rate of 4.72%. Yeah, right. And we're continuing that trend up. This mortgage survey comes out every Thursday, guys. So that being the case, I also threw in an example of, well, what if rates went up to 6%, right? So long story short, it's an $800,000 purchase with 20% down. So that loan amount was $640,000, and it equates to a $510 difference between where we were at the end of last year and where we are today. So rates have gone up. They're going to, I think, continue to tick up just a little bit here through the next month or two as the Federal Reserve continues to do two things: increase short-term interest rates as well as deleverage. Because you got to keep in mind, during this whole 2 years worth of COVID, that we were heavily influencing the market through buying mortgage-backed securities and corporate debt and what have you. They were artificially keeping interest rates low to keep the economy moving forward, right? Now we're deleveraging from that position. Unemployment's really low. People are getting back to work and all that good stuff. So they've put into plan this increase in interest rates. What does that say to the buyer out there, right? If I'm a buyer of this $800,000 house and now it's going to cost me $500 more a month, I may be having second thoughts, right? So rate the rates, just to put a pin in it. Rates are going to continue to move up, I think, for the next probably 2-3 months and then level off. What that will ultimately look like, I think rates will find themselves resting in the mid fives.
Okay, that's a prediction.
Yeah.
I personally think that it's going to be a rocky year.
Are you saying it's going to go to 6?
I think it might.
Yeah.
Because already we're seeing some people in the 5s.
Mm-hmm.
So, I mean, it depends on a whole bunch of things. Remember, not everybody gets the same rate.
Right.
It's based on credit score. It's based on, go ahead.
Yeah. This scenario was a 740 credit score, 20% down, conventional Freddie Mac 30-year fixed loan of an owner-occupied single-family residence, right? So any deviation whatsoever, credit score, property type, occupancy type, down payment, any of those deviations will definitely change your score. The higher the risk, the higher the interest rate.
And it's important that you remember exactly what we're talking about, because when you get those little ads that pop up while you're scrolling Facebook or whatever that tell you that tell you rates 1.6. I literally saw one of these like 3 weeks ago, took a picture of it and sent it to him because it's not comparing to apples. That one had somebody buying down like 4 points, which is a lot of money.
Yeah, be careful of the clickbait that's out there. That's the long and short of it.
Don't click.
Number one, don't click. Number two, my friend Ken Perry, who is the owner of the Knowledge Cube, threw this out on Facebook at the end of last week, and I shared it on my wall and all that good stuff. So, guys, there's lots of clickbait out there to try to get you to click that button, because guess what? Everybody is aware that rates have gone up. So the only way that they can actually capture your click and sell your lead off to some mortgage company is by giving you a lead or giving you a rate that actually isn't available today at all. Not. So your best course of action is to give me or a local lender that you trust a call and say, hey, this is my situation. Where am I at today in today's market? So things are still moving forward.
Yeah, they are.
I want to talk about one other thing before we jump into the current market.
Yeah, I do want to say though, that you trust is a very, very, very important important thing. If you do not have a loan officer that you trust, obviously you can always call Keith. Yeah. However, talk to your if you have an agent that you trust, ask them for their lender.